Welcome to Our 2 Cents on Your Dollar, the podcast brought to you by Strategic Insights, where we break down the numbers, decode the noise, and offer smart takes on money matters so your financial future makes sense. Democratizing access to alternative assets for 401k investors. That is one of Donald Trump's latest executive orders, and today we're going to discuss what it is not, and some things to consider along with it. Well, maybe we should even start there. Why do we have to be careful when it comes to alternative assets specifically?
Yeah, you look at asset classes really from a risk perspective, and I think that's the key thing. And so these types of asset classes, a lot being stuff that's been, really implemented in this shorter period of time, things that haven't been around for very long, don't have the historical data, don't have the evidence, don't have, a lot of the barriers really around them as well too that you see with some of the other asset classes to provide some protection for consumers. We look at these asset classes as a strategy to offset and to diversify across traditional asset classes that we typically use. But a lot of them have not been around for that long, and carry a weight of risk and liquidity issues that consumers aren't aware of and don't have the understanding and don't really understand really how they work and how they're being invested and derivatives around them as well too. And so, there's a caveat in the way that we can approach them as advisors and really kind of dancing around that and really kind of treading the water a little bit when it comes to discussing these things because of those nuances. And if that's the case for us, it's really interesting to think how are consumers, how are investors without background and knowledge supposed to have confidence around investing in these types of things and feeling comfortable doing so.
Yeah. Okay. So you said a lot there that I want to unpack, and we should probably do that and define a couple things for the viewers. So what are alternative assets? What does this executive order specifically mention?
Alternative assets are investments that's not a stock. That's not a bond. So we're talking about things like even real estate, cryptocurrency, private equity, private credit. They're usually riskier. They're not as liquid, and the costs and fees are higher.
Okay. Now, it's called democratizing access to alternative assets. Why the need to democratize? What does that mean?
Because typically these investments are not available to your everyday investors. For example, there's $8 trillion in 401k plans, and only 2% of 401k balances have allocations to private equity. And typically to invest in these types of strategies, you need to be an accredited investor, which means as an individual, your gross income has to be at least $200,000. And excluding your home, you need to have a net worth of $1 million. So there's definitely a barrier to getting into these investments.
Why do those barriers exist? Is it because of the risk you mentioned?
Yeah, I think they want to make sure that individuals that are investing in these type of things have some type of historical financial background and history as far as some type of affluency when it comes to this type of investment, and understanding the liquidity aspect as well too. That's a big thing, right? Because as James mentioned, these typically come with higher fees. So the costs in general to get into these types of investments are going to be typically higher than your traditional equity and fixed income investments, as well as the liquidity issues that come with them as well. So an individual that has a lower net worth and starts investing in these things, if you want to have access to that and to be able to utilize those funds and have that liquidity, it's a lot more difficult than it would be your traditional investments.
If I'm just getting started with my career, so I'm in my 20s, my 401k is not really liquid anyway, right? So does liquidity even really matter in that scenario?
Yeah, yes and no. In that scenario, it would, because you still have access to it. You can take loans. There's hardship withdrawals, but when we mention liquidity, we're talking about it from an investment perspective, where if you invest in these alternative strategies, your dollars are locked up for it could be 5 to 10 years. So if you need the money, you can't access to it. But I'm sure we'll mention later on that what we think more than likely, you won't have a situation where a 401k investor or employee can allocate 100% of their funds into private equity anyway. So
Yeah, I think it's I think it's less important, obviously, for younger investors. You know, with this being the circumstance inside the 401k plans, the only caveat would be if you wanted to reallocate to other investments. And so, there may be some restrictions in regards to putting assets inside some type of alternative that has liquidity restraints, yet at some point in time in the short-term future, you may want to reallocate to something else. So there may be some restrictions in regards to reallocating outside of those investments if you only held them for a short period of time. But besides that, right, if you're a younger investor, your liquidity needs are a lot further down the line. So if we're looking at it from a time perspective, it may be a little bit more appropriate for those individuals to be able to utilize it when it just comes from that perspective.
You're enrolled in a 401k, you're putting money in. How are funds that I'm able to invest chosen? Like, is this executive order saying, hey, all my 401k money is going to be put into a private equity fund and I have no control over that?
No, the executive order is asking the Department of Labor to revisit their current their laws and rules specific to 401ks and see if there's wiggle room to add alternative investments and identify. There's also wiggle room into reducing some of the litigation that's involved with keeping 401k plans and retirement plans compliant with ERISA rules.
Yeah. So currently, right now, the way that works is the record keeper, which is the 401k company, determines and decides which portfolio managers they want to partner with and allow their investors to invest in those specific types of funds. So they have a due diligence and a responsibility to vet and make sure that the portfolio managers that they're utilizing and working with are providing all the needs that they have for their specific investments. So typically, as a 401k participant, you'll have a select group of funds available to you in your fund lineup, and those funds will all have different investment purposes, different timelines in regards to the allocation, right? So we've discussed in previous podcasts target date funds, but there'll be individual funds also available to you within the plan. And so as the investor, you'll have the selected group of individual funds that are available to you, and those are all should be vetted by the record keeper, as well as the business owner who's managing or who is putting on the plan as well. There's a fiduciary responsibility for them to make sure that what we're providing as far as eligible funds to invest in for our participants are funds that we feel comfortable with, that can meet the goals and the needs of the 401k participants.
So that sounds like a lot of pressure for small business owners, and I think small businesses account for a large percentage of businesses in the United States, as well as employees with small businesses. So you're saying that those business owners are going to be responsible to decide, well, they're going to ultimately be responsible to decide which funds are allowable in 401ks, and they may or may not allow alternative assets in them. Is that what I'm understanding?
Yeah. They'll have with this executive order. What they're trying to do is allow an opportunity for individuals to really have the choice to implement it if they want to. But you don't have to, right? So if you really want to stay away from these riskier types of investments, not participate or not allow your employees to participate in these types of investments and avoid that whole thing as a whole, you surely can do so. You'll have that opportunity to do that. But yes, there's going to be a responsibility on the business owner to make sure that whatever they're allowing in the plan is something that they feel comfortable with, and it's been vetted. And, that's a lot of risk and pressure for the business owner to make sure that that's done appropriately. And so they're going to end up, deferring to the record keeper or the advisor, or whoever that's helping put the plans together, and has a little bit more, understanding, background, and expertise in fund selection.
Yeah. Okay. Also, a question that came up from a client, and she gave me permission to share this, is she has an IRA, and she was concerned that this would apply to her, but the executive order says for 401k investors. So would she be impacted as an IRA participant or investor or holder or whatever?
She would not. Yeah, IRA accounts are individual retirement accounts, and this executive order is specific to 401ks, which are employer-sponsored plans. So IRAs would not be affected.
Do we know if this is going to apply to 403bs, 457s?
We don't. The white page that came out from the executive office specifically said 401k plans. So not sure if it's going to define other ERISA type of plans as well too. I'm sure it's probably in the works, because you think about nonprofits. If there's a big part of the retirement planning business that governs over nonprofits, and so they see 401k plans now have the capability to be able to utilize these type of asset classes. I'm sure they're going to be like, all right, what about us? I'm sure they're next.
Okay, so I'm curious. We're talking about 401ks and all the funds that you have to choose from. I think it's typically anywhere from 20 to 24. But from my understanding, there are a lot more funds in the entire world. So if we're going to add alternative assets, there's going to be even more choices, or how's that going to work? Like how am I supposed to know? It sounds like there might be a lot of safeguards, right? There's the business owner that's going to choose the fund. There's the record keeper that's going to help. And then ultimately the participant is supposed to decide on which funds that they choose. Okay. Where do I even start as the participant? Like, how do I know if this is a fund I want to invest in or not?
It's going to be difficult. It's going to be difficult for all parties, because even the record keeper or investment provider, which helps with the plan provider or the employer pick funds, and they also hire third parties to help them assess which funds to use, just to show the Department of Labor that, hey, there's another party. So it's going to be difficult keeping the cost of these plans low, and at the same time keeping it compliant with Department of Labor rules, and to protect the average American that's investing into these types of plans. It's going to be very difficult. In other podcasts we've discussed that 90% of active managers or mutual funds underperform their benchmarks, and that's with public information. And we've been talking, there's so much research on it, and we've been talking about it with our noses bleeding. But when you look online, there's still more money in mutual funds than index or exchange traded funds, and mutual funds underperform. And so now we're going to be adding alternative investments that there's not as much information, there's liquidity issues. So it's going to be very difficult. Yeah.
Yeah, I think Gary Gensler gave testimony to Congress that there's about 18,000 private equity funds. I think a 60% increase in the last few years, something like that. So we see a lot of mutual funds, not a lot, but some mutual funds, they die out.
Right. Oh, yeah.
Yeah.
Yeah, and so it stands to reason that in private equity it's probably going to be even greater.
Yeah.
Yeah. Did y'all see that slide or that information about return dispersions between global large cap funds, for example, versus private equity, for example?
Right.
Can y'all talk about that a little bit?
Yeah, just the variability of returns. For large companies, well-known companies, the returns are very tight. And that's because they're well-known companies. There's a lot of analysts. There's a lot of research and information that's already available. But when you go down the tier and you go down to smaller companies and then private companies where there's a lack of information, the variability of returns between them is way much wider. So the concern would be is which one are you going to pick to add to your 401k plan?
What do you make of the argument that the number of publicly traded companies has declined? And so you don't want too many people consolidated, their investment money, their retirement money consolidated in a small number of companies. So you have to open it up to private companies. And I think Vanguard even did a study. Well, there's many people saying that private companies are staying private for longer, but Vanguard has since rebutted that a little bit. So what do you make of that argument that we have to democratize private markets for the good of everyone's retirement? What do y'all make of that argument?
I like that you have options. I like that you have options. However, I also don't like that you have options. Because one of the issues with 401k plans, and that's why they have now automatic investing features in 401k plans as soon as you meet after you've been there as an employee for a certain number of months, is that there's studies that show that it takes a long time for an employee to start contributing into a 401k plan. And they say it's because they don't know the features of the 401k plan, they don't know the benefits of it, and they don't understand the investment options, which one is for them. And but now we're going to be adding more options, so you're adding more complexity to the situation, and so it's both good and bad. Yeah.
401k plans, purpose of the plans is for retirement, investing in retirement income, and so we start adding a level and layer of complexity and adding more options on top of what's in these traditional types of plans. And over time, what that typically does is it muddles the portfolio. And we start adding different funds, different layers, trying to diversify way more across different asset classes. And you start analyzing and looking at these types of portfolios that are just all over the place. And Joe Schmo and this fund and that fund, this timeline, this duration, this asset class. And over time, you really typically see that the total return starts to wear down because of that. And so, adding all these different things, what ends up happening is people get FOMO. They step away from their traditional portfolio and their traditional investment philosophy, and they start to see, oh, here's a new shiny option and tool and toy that's available to me in my portfolio. And, at that barbecue, I want to be able to say I have something like this cool alternative investment in my account. And over time, what that ends up doing is if you're not truly understanding or have a really good vetting process, making sure that you're utilizing, really high quality alternative investment portfolio managers, it eats into the returns over time. It really does.
Yeah, and I think you have to identify what is diversification. Are you because if you're adding private equity, then I'm thinking you're trying to add more risk. So typically when someone says diversification is you're trying to reduce risk. So you have to kind of step back and think about what are you trying to diversify? Are you just trying to enhance your returns? Then private equity could potentially do that, but you have to navigate through the thousands of private equity funds and see which one will actually outperform.
Yeah. Okay. You mentioned earlier about litigation. Sometimes correct me if I'm wrong, but it feels like whenever we democratize things, that's when the potential for litigation opens up. Can you talk about that a little bit?
I think that's why it checks off all boxes. It's good for everybody, even attorneys, because you're adding private equity. So the largest private equity company now probably has $1 trillion in private equity funds, and the one after that has 500 million. And there's a demand from the everyday investor, just because they are sexier to talk about. Even though we don't know the one that you've chosen will actually outperform traditional investments, they are sexier, and so it checks off a lot of boxes. There's a demand for them. The financial markets will definitely make money. Financial advisors do have the skills and the understanding of how these work. Will probably get more clients. And we'll also feel the pressure from their clients to put them in these kind of funds, whether or not it makes sense for them.
Yeah.
And then it increases litigation, because everyone wants the same things until it doesn't work, and if it doesn't work for the everyday investor, that's where litigation comes in. It's okay. Well, it's never okay to lose money. If the big guys are losing money, nobody really cares. But if the little guy, the everyday little guy loses money, then you're going to have a problem.
We've already seen an uptick in litigations with 401k plans over the past couple of years, really just circumventing around fees, costs of plans, costs of funds, things like that. It's gone up, I think, almost 40% over the last 2 years. And so with that being the case, and now introducing an asset class that historically speaking is way more expensive than traditional investments, I'm curious to see what that ends up looking like. And they're obviously going to have to bring down their costs to a degree. And maybe that's because of the scale that they assume they're going to be at, that they can drive down costs for these funds to make it reasonable inside of these plans, but they're still going to be more expensive than your ETF inside the plan. They're still going to be, more expensive than a lot of the mutual funds, standard mutual funds in these plans as well too. So, costs matter in the absence of value, right? And so at the end of the day, if these funds aren't performing to the way that the investor wants, and they're also paying, double the cost of these funds at the end of the day as well too, I wouldn't be surprised to see those litigation numbers continue to tick up.
Okay, so to that point, I know sometimes some 401k investors will decide, they'll throw up the white flag. They'll say, hey, you know what? I have no idea which funds to pick, so I'm going to choose this asset allocation fund, and I'm going to let the manager decide how to allocate those assets. Is that what well, we don't know exactly what's going to happen, right? But can you talk about that a little bit, about these alternative assets potentially being in asset allocation funds?
I think that's more than likely where they'll end up going, especially when they initially introduce this into the landscape. Because what that ends up doing is it ends up taking that responsibility away from the participant. So we've talked about target date and asset allocation funds, and typically how those work is there's a retirement date assessed to that specific portfolio, that specific fund. And the closer that we get to that target date time frame, the more conservative the portfolio becomes. And so the responsibility is on that portfolio manager to continue to rebalance and reallocate the portfolio to the timeline of which that fund is specifically made for. And so within that target date fund, they'll introduce a sleeve of that alternative asset class and continue to adjust the weighting on that alternative asset class over time. And it's going to be the responsibility of that portfolio manager to then obviously vet their fund managers for those alts that they're going to introduce into the fund. But what it does is it'll at least take off a little bit of that responsibility on the participant that's worried, hey, how long do I stay in this specific fund? What percentage do I allocate towards it? Hey, I'm getting closer to that retirement date. Do I reduce my private equity exposure and then add some more private credit? There's liquidity concerns. I'm going to start taking withdrawals. How much should I, allocate to one to the other? They're going to probably try to take some of that responsibility off of you by doing it inside that target fund. But, now you're depending on them to get it right at the end of the day.
So how do you all view the industry's argument that these alternative assets are already in your retirement plan through your big state pension? What do you all say to that?
You got to be careful. Just because you're using the word big and professionally managed alternative investment classes doesn't mean there is outperformance. And so there's also studies you can look at when you look at the biggest endowment funds that have had the resources and access to, these types of investments, and you can look at their returns versus just like the S&P, and you'll see that the majority of them, do not outperform. And so you still have to be careful and do your due diligence.
Yeah, I think the criticism is, these participants get access to these types of investments. We don't, blah blah blah. But these are defined benefit plans, right? And defined benefit plans, the way they work is you're getting a fixed amount, for the rest of your life. So it's on the plan and the plan sponsor to make sure that the fund is growing or staying funded as long as they can, to make sure that all the participants continue to get their pension dollar that they get for the rest of their lives. So the individual isn't actually specifically investing in these alt investments themselves. They're just getting that fixed pension amount on a monthly or annualized basis. So responsibility is not on the participant. The responsibility is solely on the plan provider, or that big pension plan, to make sure that they're providing the income for all their plan participants.
Yeah, and I was thinking about this too. Like you keep mentioning, we keep hearing the word, democratizing these strategies, and I just think about it from an investment firm's perspective. Are you going to give your best ideas? Are you really going to give it to the everyday American in their 401k plans? And what are you going to do with your biggest clients? So, it's just, how much access will we actually have compared to your biggest clients at the end of the day? Because you're going to put these in 401k plans. Well, so something to think about.
Well, there you have it. Democratizing alternative access for 401k investors. It is an executive order. Some of Trump's executive orders have not been implemented. So be on the lookout, educate yourself. You still have control. Your IRA is not going to be impacted. So just make sure you're informed. Thank you for tuning in. Please make sure to follow, like, and subscribe. Thank you for joining us on Our 2 Cents on Your Dollar, proudly presented by Strategic Insights. If today's conversation brought you clarity, please pass it along, and don't forget to subscribe, share, and check the description below to learn more about us. Until next time, stay informed, stay invested, and stay strategic.